Welcome to this explainer. Today, we're diving into a massive economic mystery that is playing out right behind our screens. We are literally watching what could be the single largest shift of capital in human history, and it's all revolving around artificial intelligence. But there are some pretty major cracks forming in the foundation. So we're going to break down exactly what's happening, where all this money is going, and why it absolutely matters to you.
Let's kick things off with a question that hits right at your wallet. Why did Apple make history back in June of 2026 by raising prices mid-cycle without even launching a new product? Think about it. Apple is a creature of habit. They launch a product, set the price, and they hold it. But suddenly, right in the middle of the year, they just completely toss that playbook out the window.
Out of nowhere, the MacBook Air shot up by 18%. And it wasn't just the laptops either. The iPad Pro jumped 20%, and the Apple TV spiked by a crazy 54%. Now, this wasn't some minor tweak for standard inflation. This was a massive, sudden jolt to consumer electronics pricing, and honestly, it left buyers completely stunned.
It turns out, Apple actually explained this unprecedented price hike. They stated that soaring memory chip prices, driven entirely by the AI boom, forced their hand. They basically admitted they just couldn't absorb the costs anymore. So the richest, most vertically integrated tech company on the planet essentially pointed the finger at this hidden war being fought over tiny memory chips thousands of miles away.
Which brings us to part one, inside the data centers and the macro mechanics of the AI boom.
To really grasp that sudden surge in cost, we have to look at where AI actually lives. You see, your phone doesn't have the brainpower to run these massive AI models locally. Every time you ask a chatbot a question, the heavy lifting happens in massive physical data centers. Picture giant windowless industrial warehouses just packed to the brim with metal racks. Each of those racks is loaded with up to 100,000 Nvidia chips, which run about $30,000 a pop. By the time you buy the land, pour the concrete, and figure out the insane logistics of powering and cooling these incredibly hot chips, a single large AI data center costs anywhere from $10 to $25 billion to build. Billion with a B.
And just look at the staggering trajectory of the capital expenditure here. This is the cash they're pouring into physical assets like servers and buildings. Back in 2020, before this current AI wave really hit, four key players, Amazon, Meta, Google, and Microsoft, spent $90 billion combined. By 2023, that climbed to $147 billion. But by 2026, a mind-bending $725 billion. That's literally an eightfold increase in just 6 years. They are pouring absolute fortunes into building out these data centers.
And according to PIMCO, it gets even wilder. These tech giants are currently consuming 94% of all their operating cash flow just to fund this infrastructure build-out. Let that sink in for a second. The actual cash generated from their regular businesses. For every $100 they earn, $94 goes straight back into AI infrastructure. That leaves a mere 6% for dividends, stock buybacks, employee salaries, and, every other type of innovation. They are betting almost the entire house on AI.
So why make such a massive, concentrated bet? Well, it comes down to the sheer volume of information our world is producing right now. These companies are going all in because the world is projected to generate over 100 times more data in 2026 than it did in all of recorded history up to 2010. We went from 2 zettabytes to an estimated 221 zettabytes. It's almost unfathomable. The tech giants believe that processing this absolute ocean of data is going to make every dollar they spend today look like a total bargain tomorrow.
But we really need a reality check on the math here. Let's move to Section 2. The $600 billion deficit.
Think of it like spending $10 million to build a massive coffee factory that only sells $400,000 worth of coffee. The crucial takeaway here is this staggering deficit calculated by JP Morgan. Look, if you invest capital, you generally expect at least a 10% return on investment. To justify their massive spending, the AI industry needs to bring in about $650 billion annually. But if you combine the revenue of all the major AI models right now, they're only earning about $75 billion. That leaves a massive annual deficit of roughly $600 billion. For every single dollar the AI industry brings in, tech giants are spending 9 to 10 times that amount. Now, the massive assumption propping up this entire operation was that enterprises would happily pay premium prices for AI tokens forever, basically assuming it would make them wildly efficient. But the overwhelming consensus from major consulting firms, it shows that enterprise return on investment is currently broken. McKinsey says 73% of deployments fail to hit their projected ROI. MIT notes a 95% failure rate in measurable financial returns. Even the CEO of Palantir came out and admitted that many enterprises feel these AI tokens are creating literally no value for them right now.
So as a result, instead of happily paying those premium prices, companies are abandoning expensive models. We're seeing real-world examples of this play out right now. Uber publicly admitted they blew through their entire annual AI budget in just 4 short months, and an AI startup named Lindy realized they were spending more on their AI software connection than on their entire employee payroll. So what did they do? They switched to a cheaper AI model and instantly dropped their costs by 90%. Bottom line, enterprises are actively looking for the cheap way out.
But here is the catch. The tech giants are still building those data centers anyway, which brings us right back to the hardware. Major memory chip factories like Samsung faced a choice. They could sell standard memory for laptops, or they could manufacture highly specialized high-bandwidth memory for AI data centers. And since AI data centers are willing to pay 10 times more for their memory, these factories made the obvious business choice. They shifted a massive 93% of their production to AI chips, essentially abandoning the standard consumer electronics market.
And that sudden disappearance of standard memory chips caused a massive supply shock. The price for regular PC memory spiked 5.5 times in just 6 months. The cost for a single gigabyte shot up drastically. And that right there explains exactly why your new laptop or iPad or Apple TV got so incredibly expensive out of nowhere. Whether we realize it or not, we are all essentially paying a hidden AI tax.
Which leads us perfectly into Section 3. The Telecom Bubble Parallel and History's Warning Sign.
To understand if a crash is actually imminent, we can learn a lot by looking backward at an economic concept called the capital cycle. It goes like this. First, the promise of high returns attracts a flood of capital. Second, that capital just keeps flowing until massive overcapacity is built. Third, when the returns don't match those huge initial investments, the market collapses. And finally, the few companies that do survive buy up the cheap infrastructure and make a fortune when demand finally catches up. We saw these exact 4 steps play out perfectly during the massive telecom and fiber optic bubble of the late 90s.
Back then, the internet was absolutely exploding, and the expectation was that internet traffic would double every 3 months. Driven by that hype, telecom companies poured $500 billion into laying fiber optic cables all across the country. But the reality? Vastly different. Internet traffic grew, for sure, but not nearly fast enough. By the early 2000s, a staggering 97.3% of that installed fiber cable just sat completely unused underground. Because there was almost no revenue flowing through those cables, bandwidth prices collapsed. The resulting market crash wiped out $2 trillion of market value. But here is the really vital takeaway. The technology itself was real. The internet really did change the world. Over the next decade, surviving companies bought up that cheap, unused wreckage. And that overbuilt, previously useless fiber actually became the essential physical backbone for the modern internet. It's exactly what made giants like Google, Netflix, and AWS possible today.
So, moving to Section 4. 2 paths forward at tech's crossroads.
Bringing this all back to today, the big question is, are we building the inevitable future right now, or are we heading straight for a collapse? It is super tempting to say this is exactly like 1999 all over again, but honestly, it's not a perfect parallel. You see, the telecom startups of 1999 were funded mostly by debt. They were losing money and trading at an insane forward price-to-earnings ratio of 60x, meaning stock prices were totally detached from reality. Today's AI boom, however, is being funded by companies like Microsoft and Google, literally some of the most profitable enterprises in human history. They're funding this mostly with cash, and the market trades at a much healthier 26x multiple of expected profits. So it's a highly complex gray area, which means we're really facing 2 distinct, very serious paths forward. Path 1 is your classic bubble pop. If the returns just don't materialize, we could see a sudden, aggressive halt in corporate spending. This would mean massive IT sector job losses as companies slam on the brakes and, inevitably, a really painful market correction for tech stocks worldwide.
Alternatively, we have path 2, the race to profit. If the bubble doesn't pop, these tech giants still have to find a way to cover their $725 billion infrastructure costs, right? So how do they do that? They drastically raise AI prices. In this scenario, the cheap, accessible AI tools we all use today will vanish, transforming AI into a highly expensive luxury item that only major corporations can actually afford to run.
As the tech world relentlessly builds $1 trillion infrastructure for a future that hasn't fully arrived yet, we find ourselves at an unprecedented crossroads. We're either overbuilding a ghost town of servers, or we are laying the foundational tracks for the next century of innovation. So, I'll leave you with this to ponder. Are we currently watching the greatest bubble ever inflated, or the greatest bet humanity has ever taken? Thanks for joining me on this explainer, and I'll catch you next time.